On your screen here is the risk assessment or P&L assessment from Thinkorswim based on this Disney trade idea that we have been mulling. This is the Disney September 85.90 1x2 where we would sell the 85 call to fund the purchase of 290 calls. Now this is a bullish outlook on the stock as it approaches earnings. Now why are we interested in the bullish side after earnings? Well, first, if you look at our free options implied earnings move chart on SpotGamma.com and free resources, if you hit Disney, you can see that there is an estimated 5.2% move in the option space. And we think that that could be a little bit low. Now, why do we think that that implied move could be a little bit tight? Well, for that, let's head over to the chart first. And what you can see here is that Disney is at lows that go back nearly to the COVID pandemic lows of 85. This is a stock that just cannot seem to catch a bid. Everybody knows the story and knows the reason why. But what is more interesting to us is that if you look at our Equity Hub tool and you flick into the history, you can see that this put wall level of 85 has really not moved much over the course of the last 10 sessions, nor if you look back over time, has it moved over the last, say, month or two. So this has been a level at which traders aren't really betting that there's much more material downside to the stock. Now, if we break that down a little bit more, there's a lot of lines on this chart, but what you see here in blue is put gamma. So there's a lot at 85, there's a fair amount at 80, but if you look below 80, there just really isn't much. And so what we think is that, look, there's not many people positioned or betting on Disney taking out these new lows and going down to into the 70s, let's say, or breaching that COVID low. Further, if you look to the upside here, you notice there's this very large strike at 90, and then we have what is called our call wall, which is up at 100. So as the position or as the stock starts to rally, there's a lot of gamma that could help to possibly squeeze this thing and move it up into this 100 level. Now, over 100, we don't see a ton of positions, which suggests that they move higher could kind of peter out a little bit. But really, we like the possibility of the stock very quickly going up to this 100 because of the amount of gamma, you could say, may squeeze the stock up into the 100 level. Now, lastly, if we look at this risk reversal reading, what we can see here is that the fact that this purple line is high, it's telling us that traders are buying calls here versus selling puts. And what this means is that the way that traders may be expressing a possible bottom in the stock is to also buy call positions. Now, if there are a lot of long calls in Disney, or if traders are positioned that way, that could help this gamma squeeze in the case of an earnings breakout. So for these reasons and for this basic information, this is why we like this trade and we think it's very interesting. Again, this is the 1x2 selling the 85 Disney call in September to buy 2 of the 90s. It has fixed risk properties, which you like, so you have limited downside. But if the stock does pop and really start to move, you can see that as we shift higher, that P&L can really start to work in our favor. So this is our favorite Disney earnings trade. If you have any comments or questions on it, please leave it in the section below, and we will make sure to get back to you. And if you'd like to try out any of our tools, please head over to SpotGamma.com. You get a free 7-day trial.